to introduce the speaker, sir, Cotha Srinivas, please.
Thank you, sir. CA Cotha Srinivas garu is a BCom graduate from Bangalore University and is a fellow member of the Institute of Chartered Accountants of India, and also is a member of Institute of Cost and Works Accountants of India. He is partner of SSB and Associates Chartered Accountants, Bangalore. He served in the institute for over 2 decades, 2.5 years as a student committee member of SICASA Bangalore branch, 9 years as a managing committee member of Bangalore branch of SIRC of ICI, 9 years as the regional council member of SIRC of ICI. As a student committee member, he has served as a member and secretary of Students Association. During his tenure at Bangalore branch of SIRC of ICA, he has served in all the positions. He was the chairman of Bangalore branch during the year 2009-10. During his chairmanship, he started distributing backpack bags to CA students, and so far over 25,000 students have been benefited by this initiative. During this year, the branch was adjudged the best branch of SIRC of ICA. As a regional council member, he has served from 2010 to 2019. He was the chairman of SIRC during the year 2017-18. CA Cotha Srinivas sir, as a member of SIRC, has brought many initiatives, which include conducting ARRC, annual regional residential course on international taxation, and is successful in conducting 5 ARRCs on international taxation. He organized regional level interstate cricket tournament for members. He was instrumental in collecting around 1.5 crore rupees towards CA Benevolent Fund in the year 2017-18. He conducted around 1,000 hours of CPA programs at SIRC during the year 2017, a first of its kind. Organized 5 ARRCs during the year 2017 in Southern region, covering GST, international taxation, NDAS, and corporate law. He prepared concept paper on coaching classes as chairman of academic advisory group. He was instrumental in developing digital project for SIRC. Improvised IVR system for members and students is made available in 6 languages. Infrastructure development at SIRC was undertaken. Presented papers at various study circle meetings, workshops, seminars, and conferences on topics covering direct and international taxation. Visiting faculty at ICI Bangalore authored a book named CA Referencer for Chartered Accountants, which was released by Bangalore branch of ICI as study circles series booklet. He is life member of Karnataka State Chartered Accountants Association, life member of Bombay Chartered Accountants Society, and founder of Group Dynamics, a study group on international taxation at Bangalore and Chennai. I take it my privilege to introduce CA Cotha Srinivas Rao sir to this webinar. Thank you.
Thank you, Mr. Janardhan, sir.
Thank you, sir.
Sir, over to Cotha Srinivas, sir. Sir, Srinivas, sir, it is
Thank
now
you. Thank you, sir. Thank you. Thank you, Janardhan, sir, for introducing.
Thank you, sir.
I thank my regional colleagues, Naresh Chandrakandi and also Chengal Reddy, who are here. All the 3 chairmen and managing committee members of Anantapur branch, Kurnool branch, and Kadapa branch. Thank you for inviting us to share a few of our thoughts and knowledge on TDS. In fact, today we are discussing about, we are planning about workshop on TDS and TCS. Today we will have a session for 2 hours, and tomorrow we will be having another session for 3 hours. Is it audible? Am I audible?
Yes, sir. Audible.
Hello. Okay. So let me start with the workshop on TDS and TCS. Yeah. And I can request all of you to mute yourself so that there should not be any disturbance in between. So this is a 2 days workshop on TDS and TCS, organized by all the 3 branches, Anantapur, Kadapa, and Kurnool. In fact, there are a lot of TDS sections, almost 38 deductions are there, and when it comes to TCS, some 8 to 9 sections are there, under which you have to do TDS and TCS. but it will not be possible for any speaker to complete all those things within a matter of 5 hours or 6 hours. So we would have taken some of the important TDS provisions and some of the TCS provisions. And of course, the latest TDS provision, that is 194Q and all, we'll be discussing later. So what is that we are going to discuss today? So we'll start with an introduction to TDS, then the stages of TDS, then general aspects of TDS I'll try to cover. And if time permits, some of the important TDS provisions I'll take. Otherwise, we will take that tomorrow. Now, but coming to the introduction of TDS, we know TDS tax deduction at source has 4 words. First one is tax, as defined in the Income Tax Act Section 2, subsection 43 defines tax. Tax means income tax chargeable under the provisions of this Act. In fact, if you go and see this particular definition, 2 subsection 43, it has got 4 or 5 lines of definitions. But the sum and substance of that definition is tax means income chargeable under the provisions of this Act. Of this Act meaning Income Tax Act 1961. Then we have deduction. Whether deduction has been defined in the Income Tax Act, the answer is no. The deduction, the general meaning of deduction is the act of taking away something from a total, that is an amount of money. So whenever you are making some payment, if you withhold certain things, that's called as a deduction, a general definition of deduction. Then at source, even at source is not defined in the Income Tax Act. General meaning of at source is at the point of origin or issue. Like what do we, how to relate this point of origin or issue with respect to income taxes at the point of the transaction, when the transaction takes place. At that particular point of time, whatever happens, that is at source. So at the point of happening of a transaction. So in maybe we in Kannada we say, and even in Telugu we may say Rushi Moolam and also Nadi Moolam. It will be difficult to find out the origin of a Rushi or Nadi as such, but under the Income Tax Act, at source means at the point of happening of a particular event, that is a transaction. So generally what do we understand about the concept of TDS? It was introduced with an aim to collect tax from the very source of income, that is at the point of the transaction. And in this particular concept, there are 2 persons. One is person called as a deductor and the other person called as a deductee. And the deductor who is liable to make payment to the deductee shall deduct tax at source and remit the same to the account of the central government. So on behalf of the deductee, that is a payee, the deductor deducts certain amounts and remits that to the central government. So it's like shifting the burden of paying the tax. Now coming to the legal section, that is Income Tax Act 4 subsection 1, we know that it talks about a charging section. It's a charging section. So the Central Act enacts that income tax shall be charged for any assessment year with respect to every person in respect of the total income of the previous year. So 4 subsection 1, the Income Tax Act gives power to section 4, which is a charging section, to charge to any person for the assessment year for the income that has been earned in a previous year. So 4.1 is a charging section, so which gives the powers to charge any assessee for the income earned in the previous year subject to taxation in the assessment year. Then we have section 4 subsection 2. 4 subsection 1 gives a power to charge the tax. Then 4 subsection 2 is how to collect the tax. So what are the modes of collecting the tax? So 4 subsection 2 talks about 2 methods of collection and recovery of tax. That is deduction at source or paid in advance. So it can be the TDS. TDS, we can also include TCS and advance tax. So these are all the 2 modes of collection and recovery of tax. For that, there is one chapter. Chapter 17 deals with collection and recovery of taxes. So this is the structure of chapter 17. We have various heading, and we know that whenever it comes to the TDS, we refer chapter 17B, which is nothing but deduction at source. So it starts from section 190 and goes up to 234H, which covers general provisions, then deduction, collection provisions, then we have advance tax, then collection and recovery, then finally we have interest and levy for various defaults that has been made. So this is the structure of chapter 17. What is section 190? Of course, we will not discuss all those sections. One or two sections we will discuss and we will proceed further. So section 190 deals with deduction at source and advance payment. So the total income of an assessee we know earned in the previous year is taxable in the assessment year. So whatever a person earns income in the previous year is subject to taxation in the assessment year. But in reality, what happens, even though the income of a person earned in a previous year is charged to tax in the assessment year, but most of the taxes related to that will be collected in the previous year itself. So the income tax is recovered from the assessee in the previous year itself through these media, that is TDS, TCS, and payment of advance tax. So whatever the income that has been earned in the previous year, the tax on that will be recovered from the assessee through these modes, that is TDS, TCS, and advance taxes. Section 191 talks about direct payment. So there may be two situations. 191 deals with two situations where if a person who is earning income, his income is not subject to TDS, that is one situation. The second situation where his income is subject to TDS, but the person who is supposed to deduct TDS has not deducted TDS. So in the case of income in respect of which tax is not required to be deducted at source, and income in respect of which tax is liable to be deducted but is not actually deducted. In these two circumstances, the person who earns the income, he has to make direct payment. How he will make direct payment? In the form of advance tax payment. So wherever there is a TDS, he need not do advance tax payment. When there is no TDS or his income is not subject to TDS, then he has to make advance tax payment. In spite of having TDS, sometimes he may have to make advance tax payment based on the provisions we know where who is liable to pay advance tax. So after considering his estimated total income and calculating tax on that estimated total income, you have to reduce or give credit to the TDS and TCS that has been deducted. The balance, if it is more than 10,000, a person is liable for paying advance tax. So what section 191 says is, just because if a person's income is liable for TDS and the deductor has not deducted, it will not, the assessee cannot say because he has not deducted, I am not liable for payment of tax. The ultimate liability of paying the tax will be on the assessee who earns the income. That's what it says. In view of the provisions of section 191, the proceedings for recovery of tax necessarily had to be taken against the assessee whose tax was liable to be deducted but not deducted. Okay. So ultimate liability will be on the person who has earned the income. Now let us move on to the stages of TDS or the basic structure or the workshop on which we are dealing with. So there are four stages of TDS: D, P, R, and C. So by this time, most of you would have understood what I meant by DPRC. D stands for deduction, then payment, then returns and certificate. So let us see what are the duties of the deductor and deductee in these stages. And let me tell you, in this particular stages or with respect to the TDS provisions, I said there are two persons. One is a deductor, the other one is a deductee. But majority of the duties or majority of the work that has to be done is with respect to the deductor and not with the deductee, because deductee has got a very minimum role to play. In majority of the things, deductor is the person who has to do majority of the things. Deduction, date of deduction. What is the date of deduction? When we talk about deduction, what is the date of deduction? We said at source, at the point of transaction. What is that point of transaction? Credit or payment, whichever is earlier. So the date of deduction is credit or payment, whichever is earlier. Credit means you are passing an entry to the account of a deductee, or you are making a payment to the deductee. Whichever is earlier is the date of deduction. But there are few sections where it says only at the time of payment. This general rule is credit or payment, whichever is earlier. But there are few sections like 194, 192 is there, 194B is there, 194BB is there, 194N, like withdrawal of cash. There's no question of crediting, say the banks or a person is withdrawing cash from bank. There is no question of credit or payment, because when he gives a slip for withdrawal of cash, he will withdraw. So at that particular point only, TDS is applicable. So there are few sections where it's not on credit or payment, it's only on payment basis. But majority of the sections, it is credit or payment, whichever is earlier. Once we have deducted, what is the next stage or next step that has to be taken is payment. What is the mode of payment? Generally, it is electronic payment in Challan number 281. In fact, earlier and all, we used to do manual filings or manual paying of taxes. But of late, maybe 8 to 10 years back, we are doing electronic payment. Most of the assessees, we make electronic payment in Challan number 281. Due dates, what are the due dates? Now we understood a person, director, has to deduct tax and he has to make the payment. Within which date he has to make the payments? 7th of subsequent month. So whatever the TDS that has been deducted in a particular month, within 7th of subsequent month, he has to deduct, except in the month of March, where whatever deducted in the month of March has to be paid by 30th of April. Then what is the next step? One, we have deducted, then the deduction has been remitted or paid. Then what is the next step? Returns, periodicity and forms. So you have to file a TDS returns or TDS statements. What is the periodicity? It is quarterly returns. Quarterly in form 24Q, 26Q and 27Q. 24Q is a return filed for salary deductions, and 26Q other than salary, all other type of deductions with respect to resident deductees, and 27Q is with respect to non-resident deductees. And it's a quarterly return that needs to be filed. What are the due dates for filing these returns? Every quarter, at the end of the quarter, within 1 month, first quarter, that is April to June, we have to file the return by 31st of July. Then second quarter by 31st of October, 31st of January. The fourth quarter, even though it ends on March, that is January to March, because the payment of TDS is up to 30th of April. From that day, one more month is there, that is 31st of May. And these due dates I am saying as per the law, that is as per the Income Tax Act and income tax rules. I am not talking about what are the extended due dates. Because of pandemic, many times like last year and current year, there are extensions for many of these quarterly returns due dates. So what I am saying is as per the statute, not for the current assessment year or current financial year or current quarter. You need not consider this. You might have to see if there is any extension given for in this particular due dates as such. Then issuance of certificate. So the 3 stages are over. First is deduction, then payment, then returns. Then that person deductor has to give a certificate to the deductee. What are all the due dates? 15 days from the due date for filing the return of income. So 31st of July was the due date for filing the quarterly return in case of first quarter. From there, 15 days. Within 15 days, he has to issue a certificate to the deductee. So 15th August, November, February, and 15th June is the due dates for issuing the certificates to the deductee. Now continuing the stages of TDS, this is what we have learned is what a deductor has to do. Next, we will see what happens if he doesn't do what he is supposed to do. Like the first stage, deduction has to be done, but he has not deducted. What happens if deduction has not been done? The first thing is disallowance of expenditure under section 40A1 and 40A1A. So 40A1A is with respect to resident payments and 40A1 is with respect to non-resident payments. In case of resident payments, if amount has not been deducted, so then expenditure will be disallowed. With respect to residents, it will be 30% of the amount will be disallowed. In case of non-resident payments, 100% of the expenditure will be disallowed. Apart from that, there is penalty under section 271C. So 271C is a section where it levies penalty for non-deduction of TDS. The penalty is equal to the amount that needs to be deducted. Say, for example, there is a transaction where 1 lakh is the value of the transaction, 10% is the TDS, 10% he has not deducted, then the penalty will be 10,000 rupees equal to the amount that needs to be deducted. Then the next stage, now assume he has deducted, but he has not paid. What happens? Deducted and not paid. So what are the consequences of that? First one, the same, disallowance of expenditure under these sections. And second thing is, apart from penalty, there may be prosecution under section 276B. See, what is the difference between not deducted, deducted, not paid, and why deducted, not paid is subject to prosecution. The reason being, when once you deduct the amount, see, a deductor is deducting a tax amount on behalf of a central government or the government. So when once you deduct it, it is not your money, it is government money. So if you don't remit that particular amount to the government, you will be considered as something called unjust enrichment. There is one phrase, it was there in the indirect taxes, unjust enrichment. The same phrase will be used here also. If any person is having a government money and which is supposed to remit but not remitted, he will be considered as unjust enrichment. That is, he has become richer by that amount which he is supposed to make payment to the government. Then that being a criminal offense, he will be liable for prosecution. Then there may be a situation where the person has deducted. It is not that he has not paid, but he has paid delayed. So there is a delayed payment of the amount that has been deducted. There will be interest under section 201. So from the date of deduction, the date deductible and the date actually deducted, there will be 1% of interest for a particular month or part of a month. And from the date actually deducted to the date of remittance, 1.5% per month or part of a month, there will be interest in the section 201. Then if these two things have happened, but he has not filed the returns, what will be the consequences? Penalty under section 271H. So a person deductor has deducted and he has paid the TDS amount to the government, but he has not filed the return. There is penalty under section 271H, which ranges from 10,000 to 1 lakh rupees. So the penalty may be from 10,000 and it can go up to 1 lakh of rupees. The other situation is, it is not that he has not filed, but he has filed delayed. So delay in filing, all of us are aware that there is a fee under section 234F, which is 200 rupees per day of delay. The last stages is certificate. So he has done the 3 stages, but he has not issued the certificate. Of course, there's a penalty under section 272A, which is 100 rupees per day of delay. Like for returns, we have 200 rupees per day of delay. For certificate, for non-issuance of certificate after doing all these things, there's a penalty under section 272A, which is 100 rupees per day of delay. Now, if we see these 4 stages, deduction, payment, returns, and certificate, and I said most of this duties is with respect to deductor, and deductee has got a very minimum role to play. Now, if you see these 4 stages, the first 2 stages, that is deduction and payment, is duty of the deductor is with respect to the government. So, first 2 stages is with respect to the government, and the other 2 stages is with respect to the deductee. Why I am telling that this is with respect to government and this is with respect to deductee, meaning if a deductor deducts the TDS and he remits the TDS, that is pays the TDS, his expenditure will be allowed. But if he is not filing the returns and not issuing the certificate, of course, today, because of 26 years, certificate issuance of certificate is not very relevant. But if he is not filing the returns, then the deductee will not get a TDS credit. So the first 2 stages is with respect to the government that the deductor has to do, and the last 2 stages is with respect to the deductor. So these are the stages of TDS. Now we'll get into the general aspects of TDS. So this is a macro level of understanding the TDS provisions sections. So we saw in that chart when I gave a table of the structure of chapter 17B. So it covers from 192 to 196D. Almost 38 sections are there which talks about TDS provisions. So there are 38 types of TDS deductions, both including resident payments and non-resident payments. Then coming to the definitions. So when we take up a particular section, if you go to the particular section, if you start reading a section, in those respective sections, certain terms have been defined. So the respective sections, the definitions are available. In some cases, it will not be available in the section, but it will be available somewhere else. Say, for example, 194J, if I take, it says fees for technical services or royalty you take the definition as per section 916 or 917. So some of the terms which has been defined somewhere else in the act, they will give that particular reference. But there are certain terms in that particular section where it is not being defined either in the respective section or in the Income Tax Act, but it will be referred to other acts. Like say, for example, 194A we talk, where it is interest on securities, then they will refer securities as defined as Securities and Securities Act. So you should go back to that particular act and take the definition. So like that in Companies Act, they would have borrowed certain definitions. In FEMA, they would have borrowed certain definitions. So whenever there is a thing like definitions, most of it will be either available in the respective sections or in the act, elsewhere in the act, but few things you will get it in other acts also. Rates. With respect to the deduction of TDS, most of the sections, it is mentioned in the respective section. Say that was suppose 194C if I take, it is, you have a rates 1% and 2%. Similarly, if I go to 194I, there also you have two rates, that is 2% and 10%, 194J 10%. Like that, any section you take, most of the sections mentioned in the respective sections, except under section 192, 194P and 195. So 192 is with respect to salary. Then 194P is also a new section that has been come with respect to specified senior citizen, and 195 is other sums paid to the non-residents. Apart from these three sections, there are a few more sections like 194A, 194B and 194BB, where the rates are not mentioned in these particular sections, that respective sections. You may have to go to the Finance Act. It says rate or rates in force. Otherwise, majority of the sections, maybe almost out of 38 sections, maybe around 30 sections or 32 sections, you will get the rates mentioned in the respective sections itself. Then limits. Do we have any limits for deduction of TDS? Yes, specified in the respective sections, except in the section 195. So out of 38, almost all the sections, you have got a limit, except 195, that is payment made to a non-resident. For non-residents, there is no limit specified in the section. Right from rupee 1, he is supposed to deduct TDS. Payer status. Whether payer status is required for TDS provisions, the answer is no, I should say, because it is not based on the payer, the TDS provisions will be applicable. Basically, it will be the basis is the nature of payment. So the nature of payment is relevant rather than the status of payer. So nature of payment in the sense like if you are making an interest payment, a rent payment, salary. So depending on whoever may be the person, but the nature of payment takes a first role or first important thing rather than the payer status. But there are few cases or few sections where payer status is also important, or you may have to consider the status of the payer. Say for example, in case of 194A, 194C, 194H, 194I and 194J, in case of individuals and HUF, they are not liable for TDS, means they need not deduct TDS provided their business income or professional income or turnover in the previous year is less than 1 crore or 50 lakhs. So if their business turnover, gross sales, turnover or say gross receipts, if it is exceeding 1 crore in a previous year, then they are supposed to deduct TDS in the next financial year. Otherwise, they are not supposed to deduct TDS. In those few sections, we may have to give importance to the payer status. And this payer status, whatever sections I have mentioned, earlier it was linked to the tax audit. Say if in this case of individuals and HUF, previous year, their previous financial year, if they are under tax audit, the subsequent year they are supposed to do TDS. But now from last year, it has been changed. It has been converted from tax audit to turnover basis. Like the gross receipts, total sales or turnover from the business is more than 1 crore or from the profession is more than 50 lakhs. Then they are supposed to do TDS from the subsequent year. The next year they have to do TDS. Why I am telling this is because the tax audit limits last year from 1 crore it has gone to 5 crores, and for the current year from 5 crores it has gone to 10 crores subject to certain conditions. So there may be a situation where an individual would have made a turnover of 7 crores but he is not under tax audit. So we may be having that same mindset, thinking that since last year it was not under tax audit, this year we need not do TDS. He need not do TDS for any of the natures of payment that is subject to liable for TDS. But we have to see the turnover, whether it is exceeding 1 crore or 50 lakhs. With respect to professional, we don't have much problem because the tax audit limit for professions is 50 lakhs itself. So anybody having a turnover or gross which is more than 50 lakhs from profession, he will be subject to tax audit. Then payee status. When we talk about payer status, whether payee status we have to see. So when we talk about payee status, type of person and residential status of person. So the type of person, whether it's an individual person, we know defined under section 2, subsection 31, various types of persons are there. So whether we have to see the type of person. For few sections, the type of persons are required. Like 194C says, if it is an individual and HF, you have to deduct TDS at 1%, or other than individuals and HF, 2%. Like that, 1 or 2 sections are also there for non-resident payments. If you're a non-resident individual, one rate is there. Apart from individuals and HF, other assessees, non-residents, there is a other rates of TDS. Then residential status of person. One, you will, first one is to understand the type of person. Second one is to know his residential status. If he is a resident and resident but not ordinary resident, certain sections will apply. If he is a non-resident, the other sections will apply. So when we talk about TDS provisions, there will be only 2 categories, resident and non-resident, because even resident but not ordinary resident is also considered as resident for all these sections. So if he is a resident but not ordinary resident, if he is resident but not ordinary resident, also is considered as resident for the purpose of TDS provisions. So we can have only 2 categories. One is resident and non-resident. Non-resident means certain sections will apply. Resident means the remaining sections will apply. So to apply the section, we should know the pay status. Then deduction. Deduction, I said, on credit to account of payee or payment, whichever is earlier. Of course, credit to account of payee, it need not be only you are crediting to the account of deducting. Even if it is like a suspense account or general account you have credited, and if you know who are all the deductees or this is subject to TDS, then you have to do the TDS on that. Then basis of deduction, TDS is done on gross amount excluding GST and other taxes. Usually GST is a tax which we are collecting on behalf of the government, like any other taxes, which we only as an intermediary we collect and we remit to the government. So TDS need not be done on GST. It should be done on the amount which is excluding the GST and other taxes. The lower deduction, a payee can apply for nil or lower deduction of TDS. So under section 195 and under section 197, payee, the person who is receiving the TDS, can apply for nil or lower deduction of TDS. Under section 195, a non-resident payee can apply, and under section 197, everybody, all the residents can apply. Privileges, are there, do we have any privileges under TDS? Like senior citizens and persons having less income in the sense, a person whose total income is below maximum not chargeable to tax, that is less than 2.5 lakhs, or in case of senior citizens, even though if it is more than 2.5 lakhs, but their income is not subject to taxation. Say suppose a senior citizen is there, aged 62 years, his basic exemption limit is 3 lakhs, but he earns an income of 5 lakhs. Even if it is 5 lakhs, because of applying that 87-year rebate, there will not be any tax liability. In those situations, under section 197A, these persons can give certain forms in the form of 15G and 15H and get for nil rate of TDS. Certain incomes, like certain sections are there, like interest, they would have kept some fixed deposits in a bank where they are getting interest on which TDS is liable to be deducted. If they issue this form 15G and 15H, those people will not be liable for TDS. Apart from this, 197A also says it can notify certain persons who are not liable for TDS. Like the one common thing that it says is any persons or any income which is completely exempted under section 10 without any conditions or without any things like agriculture income is exempted, or certain trusts or funds under section 10. Now, I'm not talking about general trust, which is exempted under section 11. I'm talking about other trusts or institutions where the income is completely exempted under section 10. For those persons, if you are making any payment, there is no need for making TDS. Like there are certain funds like PF fund may be there, trade union may be there, or Prime Minister's National Relief Fund, Prime Minister's CARES Fund, like all those funds, entire income is exempted under section 10. So we have to see under section 10 whether it is exempted, and also we should see there is a notification for that, because there are certain notifications issued by under section 197. All those entities or persons whose income is completely exempted under section 10, for them, if you are making any payment, you need not do TDS. Then reduced rates, of course, for in order to increase the what do you call the cash working capital requirement of all the assessees last year, because of pandemic, there was a change in the TDS rates. Initially, it was in the form of ordinance, and then we got this section 197B in that taxation relaxation act. So any payments made between 14/5/2020 to 31/3/21 on the actual rate, you have to deduct at the rate of 75% of actual rate. Say for example, 194J, the TDS rate is 10%, 75% of that is 7.5% you have to deduct. So whatever that 1%, 2%, 5%, 10%, 20%, 75% of that particular rate has to be deducted for the period 14/5/2020 to 31/3/2021. So two things you have to remember in this, like whenever we go for an audit for the current year, last year we should see whether any payments or credits during this period, the date of deduction between this 14/5/20 to 31/3/21, whether they are deducted at 75%. Even if they are deducted at 75%, there is no problem that they have done the things properly, and there is no need for disallowance of expenditure. The second thing we have to remember, this date up to 31/3/2021 is what has been said in the 197B. The pandemic is continuing now also, but they are not extended this particular date. So whatever TDS that has to happen from 1st of April 2021, it is not at 75%, it is at the 100% rate. Whatever the rate applicable in that particular section, we have to deduct TDS. Because we cannot have that same 75% for the current year also. TDS as income, of course, section 198 says, whatever TDS that has been deducted in the hands of a assessee or a payee, that will be considered as treated as income in his hands, except under section 194N. 194N, we know this is with respect to TDS on cash withdrawals. So from a bank or cooperative society or post office, a person is drawing cash and there's a TDS subject to whatever the conditions, that is not considered as income in the hands of the person on whose the TDS has been deducted. That is in the hands of the deductee, the TDS that has been deducted, it will not be considered as income, but of course you will get a credit for that. Apart from this, there is one more section, 192(1)(a), where if the employer is deducting TDS on non-monetary purposes for the employee, that will not be considered as income in the hands of the employee. Are there any exclusions from TDS? Generally, we thought that privileges and then certain notifications issued under 197A. Are there any other exclusions? Yes, there is section 196, which talks about certain persons who are excluded from the liability of TDS or on the deduction of TDS. So if you are making any payment to central government, it's only, these are all the payees, that is the persons who are receiving the income, that being a central government, RBI, or certain exempted corporations and mutual funds, those are specified under section 1023D. If you are making any payment to these persons and it is liable for TDS, section 196 says there is no need for doing any TDS for these persons. So if you are making any payment to central government or state government, there is no need for TDS. Apart from exclusions, are there any exemptions? So specific exemption is provided in respective sections beyond limits. We were talking about the limits, like up to that particular limit or within that limit, there is no TDS. But apart from the limits, there are specific exemptions in the respective section. It's not that I'm saying all the sections will have exemptions, but there are certain exemptions in the respective section. Say for example, 194A, if I take, there it says interest paid. Certain interests are not subject to TDS. Like if the partnership firm is making interest to the partners or interest on capital, that is not subject to TDS. And in case of certain cooperative societies where interest is paid to the members, TDS is not required. And when it comes to 194C or 194J, if the amount is paid for personal purposes, there is no TDS on that. So apart from the limits, there are specific exemptions provided in the respective sections. Exempted persons. When we are talking about TDS, that is amount paid to these persons, and there are certain exemptions. But this is one what I'm talking about. Exempted persons, they need to deduct tax if they are making payment to others. So exempted persons, like if you take a trust, the trust income is also exempted. But if you are making any payment to the trust, it is subject to TDS. You have to make TDS until and unless the trust applies to the department and get a certificate, that is nil certificate or a lower deduction certificate. Then only as per that certificate you have to deduct. Otherwise, regularly whatever you're deducting for other persons, you have to deduct in case of trust also. Now I'm talking about trust making payment to others. So it is not that some other person is making a payment to trust, but trust making payment to others, whether they have to deduct TDS. They may be exempted. The trust may be exempted subject to certain conditions, but when they make payment to others, they are supposed to do TDS. Otherwise, those expenses will be disallowed. Section 40A and all will be applicable even for trust, that is charitable and religious trust assets. Advance payment, whether advance payment is subject to TDS. Yes, if the end payment is subject to TDS, then on advance payment also you are supposed to do TDS. Capital expenditure. When we talk about the nature of expenditure, there is no differentiation between revenue expenditure and capital expenditure. So even if it is a capital expenditure, but depending upon the nature of payment. So TDS is applicable if the nature of payment is subject to TDS, not whether it is revenue expenditure or capital expenditure. So if the nature of payment is liable for TDS, even if it is capital expenditure, you are subject to do TDS or you are liable to do TDS. Then what happens, what are the punishments if you don't do any of these things? Of course, we have seen that disallowance will be there, there will be interest, there will be fee, penalty, and also prosecution in some cases. Now, we are talking about TDS with respect to the expenses, nature of payment. Expenses were under TDS. Now, sales is also under TDS under section 194. Whether there is TDS on sales, either two, there was no TDS on sales. But if you see last 1 or 2 years amendments that has happened, so the new sections that has been introduced for TDS, there are various other things apart from the expenses which are brought under the net or ambit of TDS. So if you take section 194O, where e-commerce operator has to pay to e-commerce participant on the total sales made, that is the sale of goods and services, which he has to deduct TDS at the rate of 1%. So on sales, the TDS has been introduced as of now. Then purchases, whether for purchases are we doing the TDS, all these years we are not doing TDS for purchases. Of course, now certain purchases is also subject to TDS under section 194Q, which is a new section that has been introduced from this particular financial year and effective from 1st of July 2020, and that is 4 days back. So from that particular date, this is applicable on certain purchases done by a certain category of buyers. Then it is subject to TDS. Even purchases are under the TDS net. Then personal use. I said under 194C and 194J and all, personal use was not subject to TDS. But there is one introduction of section 194M. Amount spent on personal use was not under TDS. Now under section 194M, they have brought those personal use also for under the ambit of TDS. The person who is not liable to deduct under section 194C, 194H or 194J if he spends certain amounts exceeding 50 lakh rupees for the personal purpose also, then he is supposed to deduct TDS. Then cash withdrawals. So withdrawing cash from our own account. So we have kept our money in the bank or post office or cooperative society, and we are withdrawing that amount. That's our own money from the bank account. We are withdrawing. Hitherto there was no TDS on withdrawal of cash. Now with the introduction of 194N, there is TDS on withdrawal of cash also. Joint pays. If shares are determined, TDS to be done separately. So joint pays means there will be situations. To give an example, in case of fixed deposits, there will be joint holders. So first person and second person jointly, or husband and wife jointly, they will have kept a fixed deposit. Now, if the shares are determined, they can do TDS for each and every person. If both of them are assessees, it's better always to get to tell their shares and get the TDS certificate separately. Or in case of properties where we have co-owners or joint owners, if you know the shares of each and every joint owner, it's always advisable to tell that particular shares and get the TDS in their individual names. Otherwise, it will be difficult to take credit of the TDS from one person to another person. Then in case of death of payee, so there is a situation where an assessee dies in between the year and there are certain TDS that has been made during the year in respect of that particular person, then the TDS can be obtained in the name of legal representatives by furnishing certain forms to the deductor and telling him that this particular person has died and whatever the income that was earned in the name of the deceased person is liable to be charged in the hands of legal representatives. So they can give some certificates and forms and get the TDS certificate in their name. Now coming to the rules, some of the important rules. There are many more rules than this, but I have just taken the important rules. Rules number 28 we should know. Rule number 30, 31A, 31 and 37 BB. Rule 28 talks about applying, the payee is applying to the department for getting nil or lower deduction of TDS. Rule 30 talks about due dates for remittance of TDS. After deducting, the next one is payment. So what are the due dates that has been mentioned in Rule 30? 31A deals with submission of returns. So the due dates of filing the returns and what form you have to do, how to do all those things is discussed in 31A. And Rule 31 talks about issuance of certificate. After deducting and filing the statements, how to issue the certificates. And Rule 37 BB is with respect to transactions that we do with non-residents. So whenever you are supposed to deduct TDS with whenever you are making payment to non-residents and it is subject to TDS, Rule 37 BB talks about what are all the functions that has to be done by the deductor. Then some of the forms. Form 13, we have to use it for applying for lower deduction of TDS in section 197. Then Form 16, 16A, B, C, D. These are all the forms that are certificates we have to issue in these forms. Then 15CA and CB is the details that has to be furnished by the deductor. So a resident or non-resident under section 195, if he is supposed to deduct TDS for payments made to non-residents, he has certain duties to perform. That is filing information of 15CA, and wherever it is required, he has to get a certificate from the chartered accountant in form 15CB. And 24Q, 6Q, 26Q and 27Q, I set the quarterly TDS returns. Then operation. Most of the operations nowadays in the electronic mode, that is electronic payment, electronic filing and electronic certificate. Since this is there from past 5 to 6 years, so I need not go into details of this. Now everything is electronic, e-payment, e-filing and e-certificate. But the surcharge and cess has to be added when we are deducting TDS. Like say 194J rate is 10%. On that, whether you have to add TDS, surcharge and cess. The answer is no for payments made to residents. So whenever you are making payment to residents, there is no need for you to add surcharge and cess. The base rate, that is 10% if you deduct, that is sufficient. But when you make payment to non-residents, tax to include surcharge and cess. So why when once you are making payment to non-residents, that has to be increased by surcharge and cess. But when you are making payment to residents, it is only the base rate. So for example, 194J is that if you are making payment to residents at 10%, if you deduct TDS, that is sufficient. But when it comes to non-resident, it will not be under 194J, it will go to 195. If you are making payment rate of 10%, that has to be added by surcharge and cess. Why there is a difference between payment to residents and non-residents? There are two concepts or two terminologies. One is TDS, what we are discussing, TDS. There is one more terminology in international taxation, this thing, what is called as WHT, that is withholding of tax. Is there any difference between TDS and WHT? Basically, not much difference because it's a different terminology we can say. And the characteristics of TDS and WHT, that is withholding of tax, is same. But if I have to give you a difference, or if I have to see what is the difference between TDS and withholding of taxation, in case of TDS, we deduct TDS as per the rate specified in the specific section. Say in 194C, if I'm making payment to a firm, I will deduct at 2%. But the firm's tax liability will not be 2%. It will be taxed at 30%. I'm not deducting his entire tax. And he may be even incurring losses also, I don't know. So I only deduct TDS with that particular, as per that particular section, as defined in that particular section, the rates as defined in the particular section, that is TDS. When it comes to non-residents, I'm talking about WHT, that is withholding of tax. What does it mean, withholding of tax? In case of non-residents, when I'm making a payment, I will deduct his entire tax liability. That is base rate plus surcharge, if applicable, plus cess, whatever is applicable, total things I'll recover. So whenever I make a TDS in the hands of the non-residents, I would have recovered his entire tax liability. Meaning, so again, he need not, or the department need not go behind the non-resident to collect the balance taxes. In most of the, some of the cases, the non-resident need not file his return of income, provided that the deductor has deducted complete TDS as per chapter 17B. So whenever we make payment to the non-resident, we should ensure that surcharge and cess has to be added. One more thing we have to remember, when you make payment to non-resident has got a what you call, he can take the benefit of double taxation avoidance agreement. As per section 92, he can take benefit whichever is beneficial to him, either the income tax rate or a double taxation avoidance agreement. So whenever you are making a payment to a non-resident, you should see he belongs to which country. And based on this country, we should see whether India and that particular country or territory has entered into any double taxation avoidance agreement. So based on that, we should see what is the rate as per the DTAA and what is the rate as per the Income Tax Act, whichever is beneficial. Say suppose we have a income tax rate of 15% and DTA rate of 10%, whichever is beneficial will be DTA rate at 10%, because income tax rate is 15%. So we will go for DTA rate. When you are going for DTA rate, the one thing we should remember here, that DTA rate, what we take for deducting TDS, that will be final rate. So that includes surcharges, whatever you call it, everything will be included in that 10% or the DTA rate what we are adopting. So whenever you are deducting TDS in the hands of non-resident as per DTA rate, then there is no need for adding surcharge and cess. But only and only if you are deducting TDS in the hands of a non-resident as per the Income Tax Act rate, then we have to add surcharge and cess. Then foreign payments. So there are, when we are talking about non-residents, there are situations where the foreigners will raise an invoice in their foreign currency. Like you get a vendor from US, he will raise a bill in US dollars, or from Singapore, he will be raising on Singapore dollars. Australia, he will be raising in Australian dollars, or UK, he will be raising in UK pounds. So when you get an invoice or when you are supposed to make a payment in foreign currency, that needs to be converted into Indian rupees on the date of deduction. That is, when you are accounting that particular bill that is on the date of credit, or if you are making payment directly, the date of payment, whichever is earlier, you have to get those values converted into Indian rupees. For that, there are two rules, Rule 26 and Rule 115. We may have to go to that and see, because this Rule 26 and Rule 115 will say what is the rate that has to be taken. Usually it will be SBI TT buying rate on that particular date of transaction. We should take that. And for each types of income, that is for salary income, there is a date, the date of conversion you have to take will be different. For what you call this royalty payment, FTS payment, capital gains. So for in each and every type of what you call this income, they have given what is the date you have to take. That is the date of conversion you have to take. Sometimes it will be on the date of transaction you may have to take. For certain things you have to take the date of the closing date of a previous month, sometimes starting of a particular financial year. So we may have to refer Rule 26 and Rule 115 when we are making payment to non-resident, and where you need to convert that foreign currency into Indian rupees. Then other income. So usually a deductor is supposed to deduct TDS with respect to the amount that he is making payment. So if he is making, say, suppose rent, if he is paying rent of 3 lakhs, he is supposed to deduct TDS only on 3 lakhs. So he need not consider or worry about other incomes. But when it comes to section 192, that is salary deductions, and 194P, where the bankers are deducting to a specified person, they have to consider other income details that has been given by the employee or the specified senior citizen. So not only the amount that the deductor is paying, also the other incomes as furnished by the deductee or the payee, that has to be considered before making TDS under section 192 and 194P. PAN or other. Of course, by this time we know, all of us are aware that if PAN is not provided, it is compulsory to provide either PAN or other. If it is not provided, then section 206 AA will be applicable, wherein it will be higher rates, higher of the 3 rates. That is rate as per the act that is given in the specific section, or rate or rates in force, or 20%, whichever is higher, that will be applicable if a deductee is not furnishing PAN at the time of deduction of TDS. Then TAN, whether for deduction TAN is required, that is tax deduction account number. Yes, tax deduction account number is required for making TDS and also remitting the TDS, except under these sections 194 IA, 194 IB and 194 M. IA is with respect to the immovable property purchased, where you are supposed to deduct TDS at the rate of 1% if the consideration is exceeding 50 lakhs. Then IB is with respect to rent payment, where they are not supposed to deduct TDS under section 194I, and which is for a personal users like a house property. If the rent is more than 50,000 under section 194 IB, they have to deduct TDS. And 194M, that is also for personal use. If it is the payment is more than 50 lakhs. In these 3 sections, under these 3 sections, the deductor need not obtain TAN. Apart not having the TAN also, he can remit the TDS and issue the certificate to the deductee. ITR, whether ITR has to be obtained. Of course, this new section 206 AB has been introduced also with effective from 1st of July 2021. So any person, there are certain sections which are outside the purview of 206 AB. Of course, out of 38, around 6 sections are outside the purview of 206 AB. Remaining all the sections are under the purview of section 206 AB. And if you are making a payment to a person, the deductee, you have to obtain last 2 years ITR returns from the specified persons. When we go into section 206 AB, we will understand in more detail who is a specified person, which are the last 2 years that you have to obtain the ITRs, or what else you have to obtain. So ITR also is now a document which you need to obtain. Jurisdiction. What is the jurisdiction for the deductor? Whether we should take the jurisdiction of the deductor, or should we take the jurisdiction of the deductee? It's practically not possible to have jurisdiction of the deductee, because deductor will be one deductive may be plenty. So usually the jurisdiction of deductor to be considered for TDS. Rounding off, TDS amount to be rounded off to nearest rupees 10 as per section 288B. So whenever the TDS comes, say 6 rupees it comes, you have to round it off to the next nearest 10. 6 it has to go to 10. If it comes to say 14 rupees, it has to come back to previous 10. Up to 4, it can come back to previous 10. 5 and above, it can go to the next 10 rupees. Decimal. If in returns, tax rates can't be given for more than 2 decimals. So usually when we talk about resident payment deductions, it will be for all those rates will be like prime numbers like 1%, 2% and all. Even in 194 Q, if we see it is 0.1%. Whenever the TDS rate is beyond 2 decimals, like now we are not getting 2 decimals, but earlier we used to get 2 decimals with respect to non-resident payments because we were supposed to add surcharge and cess. Earlier cess was 3%, now it has become 4%. So earlier on 10%, if I add such, hello, earlier on 10% if I add, hello, somebody has unmuted, SS Parthasarthi. Hello, I request all of you to mute yourself. SS Partha something. Hello. SS Pantha, please mute yourself, sir. Okay, thank you. So I was talking about decimal points. Earlier, when 3% was the cess, we used to get decimals. That is 10% base rate, then 5%, 5% surcharge, and 3% cess. It used to come for us 10.815. 3 decimals used to come. So I request all of you to mute yourself, please. So when we got this, hello, Charan. So these 3 decimals used to come 10.815. We started deducting TDS at 10.815. 1 or 2 months we deducted. Third month after deducting 10.815, when we wanted to file the TDS return, it is not taking more than 2 decimals. So we were not in a position to put 10.815 as the rate. So hello, sir, if somebody can. Okay, sir. Thank you. So don't mute. Don't give that option of unmuting to everybody till I complete, so that afterwards they can unmute. So that 10.815% is what we deducted for first 2-3 months. When we went for filing the returns at 27Q, it will not take more than 2 decimals. So we were forced to change that rate 10.815 to 10.82 and also pay the difference TDS. Now when the surcharge has become 4%, now we don't have that problem. It is coming to 10.92%. So 2 decimals. So wherever you get 2 decimals, and these 2 decimals can happen only with respect to non-resident payments, because resident payments it's only 1%, 2%, like that only we are deducting. There is no problem in decimals with respect to resident payments. So ensure that you cannot have more than 2 decimals with respect to the TDS rate. Then revised return. Now we are talking about filing the revised returns. Now there is an option to file the revised returns also. The returns can be revised any number of times. Absolutely. Actually, there is no due date for filing the revised returns.
Exactly.
Sir, don't allow any. Sir, don't allow anybody to mute, sir. Unmute, sorry. Hello.
Sir.
Sir, please, the host can unmute everybody. Don't allow them to mute. Sorry, unmute. Mute everybody. Don't allow them to unmute, please. Revised returns, it can be filed any number of times. There's no due dates for that. Adjustments. So whether adjustments can be made. So any excess TDS made, whether it can be adjusted, the answer is yes. Payment. Sir, security la paisi, you disable muting, sir. Hello. Who is that host there?
Sir, we are doing that, sir. We are doing.
But why again people are coming back? They should not come back, no? When once you do, they cannot unmute. Can I continue? Hello?
You can continue, sir.
Okay. Yeah, when we talk about adjustments, whatever the TDS that has been made, and if it is excess, it can be adjusted with the previous year and also to the next year. Say for example, in the financial year 2021, you have made excess TDS that can be adjusted with the 21-22 payments also, or 19-20 also. So any year you have got excess TDS amount that can be adjusted with the previous year or subsequent year. Then intimation. So whenever we file the returns, that is TDS return, the department can send us the intimation within 1 year from the end of the financial year in which return is filed under section 200 A. So whenever assessee or the deductor has filed the return within 1 year from the end of the financial year, the department can give a intimation. Like 143(1) intimation we get, under 200 A also we get intimation with respect to the TDS return that has been filed. Even though there is a time for 1 year from the end of the financial year, practically what happens is when once you file the TDS returns, within a month or 1.5 months, you will get an intimation. And if you feel that intimation, there is something which needs to be rectified, you can file the rectification under section 154. So whatever the intimation received under section 200A can be rectified under section 154. There are certain orders passed under section 201. So 201 is which talks about duties of a deductor, and if some of the duties, like we know what all the duties he has to do, he has to deduct, he has to pay, and he has to file the statements. So if some of the things are not done, an order can be passed under section 201. Even if he does all those things, an order can be passed. If he is not doing that particular things, like it may be, he'll be considered as assessee in default under section 201. If the department issues an order under section 201 on with respect to any deductor, then that is appealable. We can go on an appeal under section the order received under section 201. So in section 201, there is a concept called assessee in default, and there are certain situations where the assessee is not considered as assessee in default. Like the basic duty of a deductor is to deduct the TDS. If he has not deducted TDS, then he will be considered as assessee in default. But there are certain circumstances or situations where even though he has not deducted TDS, he will not be considered as assessee in default. What is that situations or conditions? Say it is with respect to deducting. Say there is a transaction where deductor has made the amount to the deductee or credited the amount to the deductee, but he has not done TDS. The deductee has received that amount or the debit, whatever it is, the receivable amount. The thing is, the deductee has considered the entire amount as his income. Next, he has paid what all the relevant taxes that needs to be paid on that particular income after considering that income, and he has filed the return of income for that financial year. Then the deductor is not considered as assessee in default. So it is assessee not in default. So this is discussed in Rule 37 BCA and Form 26A. So the deductee has to issue in Form 26A certified by a chartered accountant to the deductor. Then deductor will not be considered as assessee in default. So even though the general condition is that if assessee who is supposed to deduct TDS but not have deducted TDS is considered as assessee in default, but because the deductee has done certain things or certain activities where because of that the assessee is not considered, the deductor is not considered as assessee in default. So is assessee not in default. But whatever in case of the deductor, the disallowance of expenditure, all those things will not be there. But the interest will be levied on the deductor because he is supposed to deduct TDS, not deducted. Interest, whatever interest that needs to be levied will be levied in the hands of the deductor. The time limit. So we understood there is a section 201 which passes an order for TDS. What is the time limit for passing the order? 7 years from the end of the financial year in which the amount is credited or paid. That is, the TDS transaction has happened. Within 7 years, an order can be passed. Or if a person has revised the return, means initially when the transaction happens, you would have filed the return, and subsequently he has revised the return after say 4 or 5 years, 2 years from the end of the financial year in which the return has been revised. So whichever is later, till that particular point of time, order can be passed under section 201. Say for example, there is a transaction in financial year 14-15. So 14-15, there is a transaction, that is a TDS transaction, 7 years from the end of the year in which transaction has happened. So 7 years from the end of 2014-15 means 16, 17, 18, 19, 20, 21, 22. So before 31st of March 22, an order under section 201 can be passed. Or 2 years from the end of the financial year in which a revised return has been filed. Say in the same example, for the year transactions happened in 14-15, a return has been filed. So 201 order can be given before 31st of March 2022. Maybe in 20, he has filed the revised return. In the financial year 2021, he has filed the revised return. So 2 years from the end of the financial year when the revised return has been filed, so 2021 is the financial year. 2 years from that, that will be 22 and 23. So whichever is later, here it is 31/3/22 or 31/3/23. We have to take 31/3/23 as the date where an order can be passed under section 201. Certification. Whether certification is required. When once you do the TDS